Good afternoon, and welcome to the Versus Systems Business Update Call. My name is Craig Finster. I'm the President and Chief Financial Officer of the company. With me is Matthew Pierce, CEO and founder. I'm going to read a quick disclaimer, and then we're going to get into the presentation. This presentation contains forward-looking statements, including but not limited to statements regarding the plans, objectives, expectations, and intentions with respect to future operations. All statements other than statements of historical fact or statements that can be deemed forward-looking statements. Versus Systems, Inc., we, us, are, or the company, may not actually achieve its plans or product development goals in a timely manner, if at all, or otherwise carry out the intentions or meet the expectations or projections disclosed in these forward-looking statements. These statements are based on management current expectations and beliefs and are subject to a number of risks, uncertainty, and assumptions that could cause actual results to materially differ from those described in forward-looking statements, including, among others, general business and economic conditions, including risk related to the impact on our business of the COVID-19 pandemic or similar public health crisis, the need for and ability to obtain additional financing, the risk that the company's intellectual property may not be adequately protected, and other factors described in the risk factors set forth in the company's filings with the Securities and Exchange Commission or the System for Electronic Document Analysis and Retrieval from time to time. The company undertakes no obligation to update forward-looking statements contained herein or reflect events or circumstances occurring after the date hereof, other than as may be required by applicable law. With that, Matthew Pierce.
Thank you, Craig. I appreciate it. Hello and welcome to the Q1 business update that is taking place on this May the 16th of 2022. The way that we're going to do this, first, we're going to do a quick refresher on who we are and what we do. We're going to do that pretty quickly. And then we're going to look at the last update to evaluate sort of how we did. And then we're going to spend the vast majority of the time on Q&A. We have a number of questions that were submitted by shareholders and others, and we'll be going over those for the vast majority of it. So let's begin. So first up, let's remind ourselves that Versus Systems is an audience engagement company. What we do is we add interactivity and rewards to all kinds of content. Interactivity mostly is done with games. These include trivia, games, polling, sentiment, casual mobile games that are related to the event that we are associated with. Increasingly, we have also been adding interactivity to live experiences beyond sports and having your QSR become more entertaining, or your lunch, or your experience leading up to the game. And this is what we're going to talk a lot about, is how we're going to grow from just on game day, just in venue, to outside of the venue, to outside of game day. And that's going to be the story of Versus going forward. We also have a lot of history and a lot of work that's been done in the reward space. We have a lot of IP that's been done around this. And the idea that as you're playing the games that you want to play, attached to the content you want to watch, you're also able to win real world rewards. Why does this matter? Well, it matters because people pay more attention to the content when you add interactivity and you add earned rewards. We've seen significant increases in time spent on site. We've seen significant increases in opt-in rates. We've seen significant increases in the overall lift of engagement, of time spent, these types of metrics that show that our work makes the content that we're attached with more valuable. Whether that content is a match or a game or a video game or a stream or any type of event where you can add gaming, you can add predictive elements, you can add trivia, and you can win real world or digital prizes. People play more, they watch more. And really, next slide, everybody across the landscape benefits when you do this. The audiences and players obviously win things that they want to win. They have more positive consumer experience. Content creators win because people watch longer, people tune in more often, fans tune in live. And brands win because they get higher engagement, better brand recall. And one of the key issues here is they get increased opt-in rates for communications down the line. So the business model continues to be three real categories of work: professional services, licensing, and advertising revenue. The professional services was the bedrock of Excite Interactive, which was the company that we acquired last year, and now have fully integrated our work into their work. And now you're seeing growth in the two other areas: licensing and software, licensing and SaaS work, and also advertising revenue, which are the more scalable, more capital efficient revenue types. that we're very excited about going forward. So the growth roadmap is seen in this way. Professional services, which we continue to perform for teams, for leagues, that grew throughout 2021 after the acquisition of Excite. But the fastest growing part of the company is the licensing and software as a service element. And we are beginning to add what is listed here as phase 3, which is advertising and other scalable revenues. This is largely coming from our relationships, our increasing relationships with advertisers and with advertising agencies, such as we did with a successful QSR launch during March Madness. Also the work that we did last year with the Canelo Alvarez fight, and the work that we have done throughout different engagements, such as those that we did with the Peach Bowl. And then phase 4, and this is the piece where the real lift is going to happen, the exciting elements that are encouraging strategic partners to join in. This is also what gets a company like Animoca, who joined in our last round, excited about the work that we're doing. Is how do we include interactivity, engagement, and rewards into streaming media and OTT? How do we add interactivity and rewards to television? How do we add it to streams? How do we add it to podcasts and various other ways that people can consume content at home? And if you think about it, this is the real shift from in venue, which is where the vast majority of our work has taken place to date, to out of venue, at home, not on game day. Whenever people are consuming their content, they're able to consume interactive and rewarded content inside of the stuff that they already love. And this is the story that is going to really be the whole of 2022 and 23 and going forward. So the big headline story here is sales bookings. Q1 sales bookings increased over prior periods. We should note that they actually were the highest that they've been in Versus Systems history. So the idea, with the exception of when we signed HP for their multi-year contract, the reason that we're talking about sales bookings here, and we will be talking about sales bookings going forward, is really twofold. One is that the sales bookings reflect more accurately what the company is actually doing, what the company is. They're closer to being a leading indicator of revenues. If you look at the work that we do with sports teams, when we book the revenue, like for example, now we're working with NFL teams. So when we work with NFL teams now, we can book the revenue now, but we won't recognize that revenue until Q3 and Q4 of this year. And then if we roll into doing the playoffs and doing the Super Bowl, that sometimes rolls into Q1. So you won't even see the work that we're doing with NFL teams if we do recognized revenue until several quarters down the line. And a shift for us in looking from recognized revenue to bookings is because we really want to show that that this is working, that the work that we're putting in now is bearing fruit. And so this is a fairly seasonal business. The sports business, which represents a bulk of our revenue, is a fairly seasonal one. Q3 tends to be the primary quarter where you recognize the bulk of your revenues. And the reason that that's true is fairly straightforward. It's when college football and professional football and baseball and hockey and NBA are all kind of playing at the same time. So you have this confluence of all the teams playing during Q3, and it sort of creates a seasonal effect, and it also obfuscates successes that we're having throughout the year. So one of the things that we want to do is talk more about bookings. And as it turns out, booked revenue in Q1 was the highest it's ever been, and by quite a margin as well. The $506,000 of Q1 that we're booking now were considerably higher than either Q3 of last year or Q1 of last year, or Q4 of last year, and quite a bit higher than they were in Q1 of 2021. So what drives that is these KPIs that we were talking about in October, November, December, that we continue to talk about up through the fundraise that we did in February. These 4 KPIs, and many of these slides are actually from those decks. We want to really reflect sort of as a scoreboard, as a report card on how we did and how we compared to what we said we were going to do. So the number of contracts is certainly one of them. Increasing contract value, and we're going to talk later during a further exploration of contract value, where the increases in contract value come from. And for the most part, they include sort of new feature sets, because in-venue work on game day is one issue, but only one part of a relationship that we have with our partners. We're also going to talk about increasing the percentage of high margin contract elements. And what do we mean by that? Well, we mean, are we working, largely this is a function of advertising and advertisers. The teams pay a certain amount into a given contract, but where it really turns and lifts is when you start to add in sponsors and advertisers associated with the events, or sponsors and advertisers doing independent activations, as we did with a recent QSR activation that we did through ENT. So think of 3 as high margin contract elements is very much related to advertising and advertisers. And then 4 is audience metrics. Here, the audience metrics, time on site, number of viewers, number of players. Anytime you're looking at an advertising-based industry, you're looking at things like opt-in rate, but ultimately you're looking at how many people see the work that you're doing. And so in addition to seeing audience growth in an in-venue way, one of the things that we're focusing on in 2022 and 2023 is growing the aggregate audience size, not just by increasing the number of partners, but by increasing the number of vectors through which we can reach those partners. So it's a matter of getting onto TV, getting into streaming, getting into podcasts, getting into venues that aren't necessarily sports venues, and growing those audiences so that the total number of viewers can be enticing to advertisers and can be leveraged in such a way that it drives revenue growth for the company. So let's look at those in turn. The number of contracts is growing. We had 44 active partnerships in Q1, including hockey and soccer and NC2A and rodeo and advertisers directly. This represented a 76% growth in new contracts over Q1 of last year. And again, bearing in mind that we're going to be comparing apples to apples, so Q1 of last year versus Q1 of this year, it was a pretty significant growth in new contracts. We did 445 activations across the quarter. I know that many of you just received our April update. We did 185 activations in April alone. So you're starting to see that number creep up month over month as well. Activations here represent a particular game, a particular instance, a particular event that we worked with over the quarter. So 445 activations was the total number of games, the total number of events that we participated in. We don't get paid on a per activation basis. We tend to get paid on a per season basis. And I'm going to describe some of the ways that we get paid, but it's important to notice how many things the company is doing year over year, month over month, quarter over quarter, and keeping that activation number growing, because they're not, while we don't get paid on an activation by activation basis, unless we're working directly with the advertisers. So in those cases we do, but on a team basis we don't. But it's still worth keeping abreast of how active we are. So what you're seeing here with contracts is, are we growing the content footprint? Are we growing the partner footprint? Are we growing the potential revenue vectors for Versus Systems? Are we growing the potential number of advertisers? And the answer to that is yes. And in particular, when you see things like the audience sizes of the teams, of the venues, of the events growing, it's not just there. We're also continuing to work with longtime non-venue partners like HP to grow that audience size and growing it globally as well. So one of the things that happened this year, we started working with a number of overseas partners. We just got back from signing up a few Japanese baseball teams, and seeing that grow is an exciting part of our business. Being able to have a larger global footprint for all of our partners will increase both the audience size and the number of vectors for potential advertisers. So we're excited about where that's going. With respect to contract value, Contract value is how are we stacking the things that we provide to our partners. In some cases, we have contracts with teams, contracts with leagues, contracts with partners who are asking us to do a particular game, a particular feature set that they want to see, and they pay an increased amount for increasing numbers of feature sets. We also see a broader space of opportunities for us to put advertisers against particular types of games, which allows our partners, which allows our team partners to have more sponsorship revenue opportunities that are beyond, if you just have one game, right? So a team might put a pump, pass, and kick game in an NFL game, might be brought to you by McDonald's, or a bingo game that might be brought to you by Toyota, for example. And so the more opportunities you have to offer up that space to partners, the more effectively you can grow revenue and increase your contract value. So this is a sampling of some of the games that we have done over the last few months. Hockey shootouts and soccer shootouts, of course, specific to that particular content type. But then you look at games like trivia, turbo trivia, skee ball, bingo, match games that have proven to be very effective, sort of universal games across a wider number of opportunities, across a wider number of partners. So the higher percentage of higher margin elements. There were no. This was something that we've been talking about doing for quite some time. That's starting to begin to bear fruit in Q1 of this year. An increasing number of our contracts have this feature in them, whereas 0% of the Q4 contracts included CPC and CPA elements. But the real star here in high margin element growth is the relationships that we have directly with the advertisers and the advertising agencies. Ent, Red Moon, and others. We're going to talk about more of those as we move forward, and certainly several of the questions that were submitted were talking directly about this. This is both experiential and digital agencies, and what's happening there is we're able to leverage their marketing energy and effort, their advertising spend, their partnerships with the brands directly to bring additional engagement, to bring additional interactivity and additional rewards to fans, white labeling it inside of either an experiential offering at a venue or wrapping it inside of a group of people that are advertising for a partner in the days leading up to an event or in the days after an event. And the example that we can talk about here with the QSR, we worked with Ent, who is a well-known advertising agency, to place QR codes on the cups that were in a QSR, quick service restaurant. And so when you got a Coke to go with your lunch, you could play a basketball game during March. And the March Madness players, they were able to play the basketball game and win free refills and win other items from the QSR. And the final champion of March Madness got a catered Final Four viewing party. The engagement on that was higher than even our partners' best estimates. We expect to do more of that work going forward. That's really where you sort of finally start to see the cover coming off of the growth, the revenue and growth potential, because it goes beyond the stadium, it goes beyond just game day, and it can be played always on. So the margin on that is really, really nice. And the partnerships that we're leaning on, they're the ones that go and get the advertisers. So that was a very good partnership for us. We're developing more tech around that. We're developing more, we're putting more work behind always on initiatives, not just on game day, but for the days leading up, for the days after, for independent activations that drive additional revenue outside of the venue. That's where a lot of our technology effort is going right now. And we're building tools to make self-serve advertising more effective, build it, make it possible, and then grow it from there. So the key to increasing value, this is really sort of the kind of the catch-all KPI for us, but the idea here is, as we've said, to grow more teams, more markets, and do so in such a way that it's not just on game day. We have very good, deep, and lasting relationships with game ops people at a variety of teams. But the shift that you're starting to see is that it's not just in game ops. You're starting to see us talk to teams about their sponsorship groups or their commercial efforts during off season. Starting to see the growth of teams as they realize that they are in reality global entertainment brands, right? And this is you're seeing this from everywhere from the English Premier League to La Liga to the NHL to the NFL, that the people that really care about these teams, and in particular in areas like the NC2A, where the fans of these teams aren't just fans on Sundays, they aren't just fans on Saturdays, they're not just fans on game day, they're fans all the time. And to start to unlock different elements that are available always on, to have predictive, to have trivia, to have ways to engage your fans on a Thursday afternoon, or when they're not at the venue, they're watching from home in Houston, or they're watching from home in Barcelona, or they're on the road and engaging with the game in a different way. That's really where sort of some of the special versus interactivity and rewards elements drive more fan engagement into the teams. And you're starting to see that in Q1 and Q2 of this year. And that's being reflected in increased bookings, as I said, as we start to unlock more and more always on stuff. The huge difference between Q4 and Q1, between Q3 of last year and Q1 of this year, was more net new business. It wasn't just renewals. You're starting to see new business that drove a lot of that lift, and the new business tends to come from always on initiatives. And with that, I think we're going to get to the Q&A. I got a very large list of questions to answer. And I'm going to start, and then I'm going to be capably assisted by Craig Finster, who is the president CFO. And let's just get right to it let's just get right to it. Question 1, can we talk about the size and scope of the contracts with professional sports franchises? Are we seeing growth year over year in the actual size of the contract? We want to determine what the revenue opportunity is within the current customer footprint. This is a good question, and one that I'm going to kind of break apart a little bit. So the answer is that the net size of the contracts is increasing, but it's doing so as a function of adding new elements. So the in-venue game day, cost of something like Filter Fan Cam, where fans go and they, the camera operator turns to them and their head turns into a football. And so they dance a little harder because they've got football for a head, or this is a very, very popular game. Many of you have seen this type of application done in stadiums globally. We are the industry leader in Filter Fan Cam. This type of application on a month by month, quarter by quarter, game by game, activation by activation measurement has not had a tremendous amount of lift. The actual spend by game dev, by game ops for the teams has not risen a great deal over the course of the last year. It's certainly between Q4 and Q1, that part was flat. It's higher than it was in Q3 of last year, higher than it was in Q2 of last year, but flat against last quarter. And the real issue here is, can we provide more functionality? Can we give new games? Can we give new experiences? Can we also grow the experience, grow the relationship beyond the game ops people? And that's been the initiative for really since we acquired Excite, was to start shifting start adding to the game ops relationships that we have and grow into sponsorships, grow into sort of the CMO type vertical, and grow into sort of the commercial relationships that they have that go beyond game day. The game ops groups in these teams tend to be very focused from the time you drive on to the lot to the time that you drive off the lot after the game. And that's a very, very powerful story for us because it's a vector into a bunch of other arenas. But for us, the real growth in the company is, can you start to add the sponsorship dollars? Can you start to add things that happen beyond the venue? And the answer to that is yes. So you're starting to see things like the QSR activation, which happened because of a relationship that we had because of the strength that we had in gaming. Our reputation in gaming helped us get the work in the QSR so that we could put the QR code on your Coke cup. The games that were played were games that we developed for sports. Obviously, we built a basketball shootout game for our relationships with basketball teams, and that was able to translate directly over into a restaurant relationship that wanted to take advantage of the season, wanted to take advantage of March Madness to be able to promote their in-venue offerings. And so things like that, where we're looking at how do we grow a sector? How do we grow a relationship with a brand? One of the ways that we grow it is by extending beyond the venue. One of the ways that we do it is by having always on initiatives that extend beyond game day. And so even if the in-venue at that moment, game day revenues are flat, the net new revenues come sort of stacked on top of that. This is also a good spot to recognize that you're starting to see teams open up new opportunities for other media initiatives, which you're going to see us announcing sort of going forward, working with teams to create new social media channels, working to create new streaming channels, working with podcasts to increase their footprint beyond just the in-stadium stuff. And that's an area that we're really, really excited by. So the direct question, the size and the scope of the contracts with professional sports franchises, they're growing both in the number of franchises that we work with and as a function of what we do for them, the amount of services, the amount of features, the amount of functionality that we add on a contract by contract basis, even if the old feature versus the old feature, that growth is pretty flat at this stage. You're starting to see us sort of stack revenues on top. Cool. So question 2, we have a significant presence in sports. What are some of the other opportunities that you're pursuing within the entertainment industry? One of them we've talked a fair bit about, ad agencies, both experiential and digital. Here, an experiential ad agent, for those of you that haven't done as much of that, these are companies that create events or create experiences that are around an event. You see them happen at concerts. You see them happen at trade shows. You see them happen at sporting events. You see them happen alongside the in-venue element. For example, this particular event outside of South by Southwest is brought to you by Jack Daniels, or this particular event outside of a UFC event is brought to you by alcohol company Y or CPG brand Z. And experiential agencies create and craft an experience for people to play and for people to get excited before the event is happening. And that's a good space for us for a few reasons. One is because some of the always on work that we do allows it to be pretty high margin. You don't have to create cards for any individual events. You just have sort of technology related to the overall subject matter. The other thing that experiential work allows us to do is that in person, we have a lot more leeway on what we can prize out. Physically being in person changes the legal and regulatory issues associated with, for example, working with spirits and alcohol brands. If you're at a venue and you've been carded, you've been assessed to be allowed inside this space, you can win a different set of prizes than you would be able to if you were at home. So we just have a wider range of partners that we can work with there. So ad agencies, both experiential and digital. The digital growth there is going to be an important one. We're going to talk about Animoca and some of the work that they've done in digital pricing, in Web3. That's an area where we're growing the business. Streaming and OTT is another key area for us. Being able to get into television, being able to get into podcasts, being able to get into live streams. This is a space that we've been working on for a while. You've seen our QR codes in the MLS All-Star game. You saw our QR codes inside of commercials. You've seen them in the Peach Bowl. You've seen them in venue stuff. You're able to take your phone, hit the QR code, begin playing a game, begin to win awards. So, and that starts with the sports work. I mean, this question presupposes the strength of the sports work. The sports partnerships then beget relationships with some of the sponsors that sponsor those sports. It begets experiential work that happens at sporting events, at concerts, at live events. But OTT is where over-the-top television, being able to talk about content that is always on to service partners. OTT is an interesting one. You're seeing a lot of, even among the biggest OTTs, even among the Disneys and the Netflixes, and you're starting to see ad-driven models be talked about, be rolled out. And ad-driven OTT is a space that we can really excel. Being able to provide second screen engagement, being able to provide real world rewards or digital rewards as a function of watching your favorite television show, and do so in a way that is sponsored, do so in a way that is ad driven. We've always been very excited about this space. And then the macro environment of watching the Netflixes of the world and watching the Disneys of the world start to add this ad driven element in is a very, very exciting space for us. Whether it's, the Discovery Warner Brothers world, or some of the smaller OTTs that cater to particular teams or particular niche audience interests, we think that's a place that we can play very, very well. And then the third area, so ad agencies, streaming and OTT, and then the third area where I think we have some opportunities to pursue in the entertainment industry is gaming. We've always liked the gaming space. We have a long-standing partner in HP, and we're very, very excited about the work that we're going to be doing with Animoca Brands. Animoca is a multi-billion-dollar company that has a huge footprint in gaming, has prizing in games, and their work there sits very well with the work that we're developing now in gaming, and specifically with rewards. We're very, very excited to work with Animoca there going forward. There was another question that we got from an investor that came in quite recently that was about Winfinite and talking about adding more games. That's where to watch that space, is the work that we're doing both for advertisers and ad agencies that is related to gaming, but also directly with games as a function of our partnership with Animoca Brands. Next question, when should we start to see the inflection point where the advertising and couponing revenue components begin to ramp? As we add more agencies, you're already sort of seeing the first signs of it. And Red Moon, Frias, others, many of these are brand new relationships, and we're doing case studies now. It's going to take a couple of successful campaigns to roll that up. So you're going to start to see that moving forward in Q3, Q4. The other place that it's going to show up is as we get in front of larger audiences. Even though we look at cost per engagement and we look at transaction rate, we look at some of the metrics that have always been very clearly areas where we shine at Versus, things like transaction rate, things like opt-in rates where we outperform the competition. That still requires a sizable enough audience to get the advertisers interested. And so the more work we do with the larger audiences, the better off we're going to be there. So the OTT and streaming audiences that are going to be launched in late Q3, Q4 of this year, some of the watch turn elements that we're looking at are going to build out that technology, build up those relationships. Some of the work that we're doing with Animoca, we expect that to pay off later in 2022. Question number 4, can you update us on the current capital position? Should we expect the company to raise capital later this year? Craig.
Um, we have $5.3 million US dollars on cash on hand at the end of Q1. Yes, we do expect to raise additional capital this year to support the revenue growth. We're very cognizant of and focused on reducing that burn rate, but we do think there'll be additional capital needed.
So as we were, related to that, this was known when we raised in February. We raised a smaller amount in February with the intention of hitting some of the milestones that we have hit or that we continue to hit with the hopes of raising later in the year. We are, as Craig rightly pointed out, working on both the revenue, increasing the revenue and managing costs such that we can improve the burn rate so that money can last longer, but we definitely expect to be raising later this year. So question 5, do you require a meaningful amount of new hiring or added costs to support your current growth expectations? If so, what has the hiring environment been like for talent? Craig, you want to take that one too?
Yeah, we don't expect to add significant headcount for these current growth expectations. There are other future initiatives we've got where we would look for engineering hire. Engineering hire has been difficult to get recently. It's tight, it's hard. That we would look to continue to add staff around. But really this hiring environment is in flux for a lot of companies. We want to make sure we find the right people. It's been harder to hire like everybody else, but we have a very high close rate when we do make offers, and we have a very high retention rate of staff. And we think that's a real testament to the team and the culture that we built at Versus Systems.
Great. All right. Additional questions. So how can you ramp up revenues more quickly, and what is your plan to increase sales? A couple things have happened here. One is we've recently hired a new sales team. We changed out some folks on that side, and we're very, very bullish on the trajectory that we have there. We like the people that have been brought in terms of the networks that they have, in terms of the outreach that they're doing. We also like some of the new technologies that we're beginning to roll out. So the partnership with Excite was a very, very good one strategically for us. It took a while for us to put together the technologies, and it's something that we're still working to do to make sure that what we call the Versus backend, the pricing platform, matches with the fan engagement elements that were provided by Zio, which was brought in by Excite and used by the huge number of sports teams that they work with. Being able to have a better pricing path is something that we are actively building, that we expect to have a new version of at the end of this quarter, at the end of Q2. One of the things that we're very, very excited about in this moment is improving the quality of the analytics so that it's easier for our partners to see, right, that $1 spent with Versus is $1 well spent, that $1 spent in this kind of way with experiential and interactive advertising is $1 that yields, positive return on investment, positive return on ad spend, and that it is, in excess of our competitors. Being able to pull those reports faster, a lot of the stuff that's happening below the surface, and a lot of the stuff that isn't seen by the end player, but is seen by the advertiser, has been a lot of the work of the last, really the last 9 months. Watching that integration such that that teams can get a more durable product that is stable, that does what it ought to do, that has a better and more productive path for rewards, that it has a more attractive path for rewards, that it has something that people are more likely to interact with and play with. And then at the end of it, you get a report that says, here's what, you put this much in and you get this much out. And like I said, a lot of these things aren't really as visible from a technical perspective, but you're seeing, with every release, right? We do sprints every 2 weeks, right? And every new release is showing improvement both on stability and on functionality, largely for our partners. And so this is related to this question of ramping up revenues more quickly, because you're starting to see the advertisers take hold of that. And this is table stakes, right? Like, to be an advertising company, to be an enterprise grade software development company for advertising, for the kinds of agencies that we're now working with, to work with the kinds of partners that we're now working with. These analytical tools have to be in your arsenal, and you're seeing that now. So the planned increase revenues is both on the sales side and on the product side, right? So on the sales side, it is increase the number of partners and increase the number of sponsors, right? So, more teams, right? Japanese baseball, more events like the San Antonio Rodeo, more partners of this type, and then more brand relationships like those that we're getting with from Ent and Red Moon and the other advertisers that we're working with. So those initiatives are working very, very well at this moment, which is reflected in the considerably higher booked revenue that we got this quarter versus Q1 of last year. So that's the sales side. And then on the technical side, having a product that fulfills more of the goals of the advertiser, and fulfills more of the goals of the content provider. Do people watch longer? Do people play more? Do people opt in more? Do people win more prizes and come back and play again? That's a space that we're very excited about, and we think that the increase in book revenues, and we think that the increase in the stability of the platform and the analytics in particular are ways that we're going to be increasing the revenues. That said, it's also important to note that on the cost side, we're going to be managing that as well. So I don't think this is going to require significant increase in headcount, and in fact, some of the work that we're doing here is to both increase revenues and manage costs where possible. All right, question 7, how does signing partnerships with experiential marketing agencies like Ent benefit Versus? There's a couple of ways that this happens. I mean, we get those relationships because of our relationships with the sports team. So in some ways it's a natural outgrowth. But one of the things that we like about it is that it sits flush with what we've been talking about doing, which is get outside of the venue, even if you're only, a few hundred yards outside the venue, and get outside of just game day or game time, being able to do the build up to an event like the Peach Bowl, or being able to do the build up to a fight or a match or a game that's brought to you by a sponsor. We like that it comes with sponsorship revenues. We like that it comes with an agency who's frankly better at getting the word out than we've been historically. This has not been an area of strength for the company. We've not been especially effective at marketing. We've not been especially effective at telling the story. And so being able to get to those sponsors, being able to get to those audiences is an important part of what we're doing. Winning real world stuff, winning digital prizes before and after the event, that's going to allow us to work with a broader range of brands, and it's going to allow us to work with a broader range of audiences. Question 8, do you have any partnerships with international agencies? How would you expand the adoption of ZEO outside North America? Here you're looking at things like French soccer, UK cricket, Japanese baseball. You're seeing that grow. You also saw some of the work towards the tail end of last year that we're doing with HP to grow the installation base of their products beyond just the United States. We're preloaded in their work in China, in India, in the UK, in Mexico. That's growing our audiences also. I think that one's pretty straightforward. Question 9, what verticals are you targeting besides QSR? And are you planning to work with other QSRs? Yes, absolutely. Consumer packaged goods, CPG companies, food and beverage is a really strong one, particularly with experiential agencies. They tend to be sponsored by spirits brands, alcohol brands, food brands that are driving consumer trial. We're trying to get people to try stuff. And then when people try stuff and they like it, when they win it, they get excited about it, they come back and they buy again. That shows return on ad spend for us. Question 10, what's going on with HP Omen Gaming? We continue to work with HP Omen, and we are currently working with them to expand and renew our agreement with them going forward. There will be announcements around that. I would expect there to be an announcement around that in short order. Question 11, are we working with Animoca Brands or was their strategic investment passive? I don't think that Animoca does a lot of passive investments. I think that Yatsu, who's the chairman of Animoca, has a very clear vision for what Animoca gets involved with. They've always liked the way that we do pricing for in-game activities. They've always liked this idea of, play a game, win a prize. They like our patents in that space. They like our tech in that space. And we are actively working with Animoca for a variety of new initiatives, actually, that we will be announcing later this year that are a little early right now in Q1, but middle of Q2 now, but a little early to be talking about just yet, but we are actively working with Animoca brands. Question 12, do we have any contracts that currently incorporate CPC and CPA elements? Yeah, in fact, two of the largest contracts that we did in Q1 both had these elements. CPC and CPA, cost per click, cost per attempt. That's when people try to win something. We get paid in addition to the regular amount that we get paid on top for advertising. Why was the Excite acquisition good for us? The strategic synergies, I think, are very, very obvious, right? We are a rewards and prizing and engagement, company. They are an engagement platform that had a bunch of very, very good relationships with a variety of sports teams. And the issue has been that we needed to stabilize the product and bring the teams together. And we've spent the last 9 months doing just that. And I feel pretty good about where the product is, and certainly good about where the product is headed with respect to the combined software offering and the combined team that are out there driving additional engagement. Question 14, and related to the ones that we're getting live here, why is there no revenue guidance? Told you we were going to get all the good ones today. So, Craig, do you want to talk about revenue guidance?
Yeah, we constantly evaluate if that's something we should be doing, and we have not adopted giving revenue guidance because it's been difficult to forecast. Switching to this reporting of sales bookings, we think gives a good insight coming into the current performance of the business. And we're trying to talk about the qualitative things that drive indicators for success. But at the moment, we aren't forecasting revenue. You aren't giving revenue guidance. And we look at that certainly quarterly, if not monthly, about when we should adopt that.
And I think to sort of lay on top of that, it's not that we're ignorant of the value of offering guidance, yes. Right? Like, we want to offer guidance. Where the company is at, particularly, still not even a year after the acquisition of Excite, what you're trying to do when you offer guidance is be right. You're not trying to have it just go up and up and up. You're trying to be able to, within a few percent on either side, up or down, be correct about the guidance that you're offering. And the seasonal effects of Excite are an issue for that. And the obvious effects of the pandemic are still very clear in the data. It's hard to create a trend line for a live events company when havoc has been played in the live events company for the last several years. And so being able to say, well, we're going to do quite a bit better this quarter than we did in Q1 of 2022 versus Q1 of 2021. Yeah, great. So we're up 75, 76%. What does that mean? Right. And is that something that you can predict quarter over quarter going forward, given all of these numbers that are more difficult to track? Right. I mean, we want to offer guidance. I would love to be able to say, here's how we're going to be in Q3. Here's how we're going to be in Q4. Here's what's going to happen in 2023. And I mean, what your tendency to do is to just massively sandbag it and pick a low number and then crush it. But you can't do that as a public company, right? Like, you can't, like, you're punished for being wrong by too much either way. And so once you've announced that you're going to do guidance, you kind of have to always do guidance. And so until we have a clearer sense of where we're going to be 2 quarters ahead, are we going to be better than we are now? Yeah. Do we have a pipeline that's better today than it was, a quarter ago or 2 quarters ago or 3 quarters ago? Yeah. Do we have better products that allow us to sell into more verticals today than we did, 3 months ago, 6 months ago, a year ago? Yes. Are we in a better position right now than we have ever been in terms of numbers of contracts, numbers of activations, larger audiences, like a broader range of partner sets, right? Yes. And it's not close. It's not a question. the question of guidance is going to come down to when can we predict reliably what's going to happen 2 quarters from now. And because of the seasonal effects and because of the pandemic and because we have yet to unlock the power of these advertising relationships that we just signed, these are brand new, it's very difficult for us to offer forward guidance and then to offer it quarter on quarter on quarter on quarter after that. And I wish I had a better answer. I'm not trying to evade, like, part of the reason that we're going to do longer than an hour today, part of the reason that we are spending the vast majority of the time on Q&A is because these are fair questions. They're fair questions. That said, the answer is a not very satisfying one, which is we can't do that yet. We are trying, we're aimed in that direction. It's going, it's better today than it was before, but it's not there yet. And we will offer guidance as soon as we can offer forward guidance. Next question up, are you happy with your spend on sales and marketing? Craig, you want to hit this one too?
Yep. So this is a number that's growing. So as Matthew mentioned, we've expanded the team. We added 3 new hires to that at the end of March. And we're doing it both with internal spend, and we're looking for partners who can help us leverage that. Partners like Animoca, partners like Ant, partners like Redmoon. Right now, we've got a real event-centric strategy. As events come back, we're going to have more spend tied to that. We'll be at more conferences, more activations, and then we'll have digital campaigns tied both before and after those as well.
And this has been an area, so we're talking about, I think that this question, one of the things that this question is sort of getting at is something that has been asked of us, at multiple times over the last several years, which is, how are you thinking about not just the sales and marketing of your products, but the sales and marketing of the company, the sales and marketing of the stock? And for a moment, I'd like to decouple those a little bit. We are a B2B product. Talk about the products first. We're a B2B product for the most part. We provide partners like sports teams and ad agencies and advertisers and event folk and companies like HP. We provide those companies with tools to make their experiences more exciting, to make their experiences more effective. And as for the most part, white label B2B company, we lean on our partners to promote the features and functionality that we provide. We have never been capitalized to do a tremendous amount of front-end customer acquisition cost. We've never raised hundreds of millions of dollars to spend on customer acquisition cost as a video game company might, or as a content company might, or as a social media company might. We build tools that make other people's experiences more engaging. And we then lean on them to promote those prizes, to promote those experiences. And in some cases, they do a very, very, very good job of that. And in some cases, it's been less effective. We have built up a best practices, sort of book of best practices for how to promote this type of thing. But we as a company have not been, we've really never been positioned to and have never been capitalized to do customer acquisition costs to end users directly. We provide services to teams, those teams provide services to their audiences. And that's kind of how we've promoted the product. Are we putting more energy and effort into that now? Yes, we are, because we think that it's an important part of the strategy going forward to grow the audience base, to grow the number of users, to grow the number of partners that we have. So as Craig says, we're changing the composition of the sales team, we're changing the composition we're changing the actions and the activities of how we market the product. And importantly, we now have some partners who are in the business of advertising this type of thing. And so partners that we've been trying to get, frankly, for years, the advertising agencies who really need to see the work being done effectively, the Ents and the Redmoons of the world, those guys need to see real results. And we're showing them real results, which is why we're now able to partner with them in a more extended and more robust way. And so that's really going to help as well. So it's growing the team that is doing it, putting more energy and effort into sales and marketing, and then also leaning on our partners. And regarding the sales and marketing of the stock, this has been an area that we're looking to make some changes on as well. This has not been something that we've done a tremendous amount of historically, and I've been heavily critiqued for our lack of messaging on this front. There's a bunch of stuff that we could talk about that we can assign blame, but I'm happy to eat the blame there. We haven't been as effective at marketing the stock as we possibly could have been. For as good as the product is, the fact that the stock is trading where it's trading, in my view, is being careful of, I do not think that it is valued appropriately. I think that we are providing more value to our partners than is currently reflected in the stock price. And it is my job and our job to change that. And so we're going to be putting more energy and effort into that as well. Sorry, that was a really long answer, but I think a very fair and reasonable question. So, are there any plans to update the Winfinite website? And will there be any more games with Versus embedded pricing technology? Yes, we are working to increase the number of games that pricing works on. Hooking up the Versus pricing backend more effectively into Zio is going to allow all of those games, from predictive to trivia to some of the casual mobile games, to include more of it in. This is the person that wrote the question played MIB Global Invasion, and possibly also played things like NASCAR Heat Mobile, which is where kind of we started out in getting great audience traction. You're going to see some more of that inside of partners like HP, but really you're going to start seeing it in and attached to teams and events and brands and agencies. I think that's the space that it's really going to shine, as well as the work that we're doing with HP. That said, some of the work that Animoca does is very clearly a match here, is very clearly a fit. So I would watch out for future growth and development out of the Animoca vector. Okay, question 17. How are we addressing liquidity and capital raising in the current environment? This is a very, very, very challenging environment. And we can't pretend like it's not. It is bonkers out there. Craig and I have been in early stage tech for a very, very long time, and in media for a very long time. I've been working in early stage tech companies since 1999, and have seen a couple of really nice bullish cycles in there and a couple of really rough bear ones. And this one has elements in it that could be pretty rough. But we have some very, very dedicated and engaged investors who continue to be excited about where we're going. We have some partners who are also investors that are very excited about where we're going. We have some teams that we're partnering with that are looking to expand their offerings beyond the in-venue, beyond just game day. And I think that that's the opportunity, right? We have to look at what has happened, not just to us, right? There are a number of companies across all kinds of sizes, right? It's not just micro caps, it's not just tech, it's not just media. We happen to be all three of those that have really, really, really taken a punch in the mouth. And we are doing everything that we know how to do to manage the cost side of it, to increase the revenue side of it, and to do so in such a way that preserves and grows value for the future. Not just for us, not just for our partners, but for our shareholders, for the people that are listening to this call. And it is incumbent upon us to do everything that we can to return value to shareholders, no matter what the environment is. Whether it's the tail end of the crazy bullish market that took us from $0 to $150 million in market cap, to the more recent times that took us from $150 million market cap to where we are today. And we have to navigate that. And we're not going to pretend like it's a super easy time to raise money. It's not. But we're very, very excited about the technology. We're very, very excited about the team, and we have a really nice set of investors that have historically, continued to support us and have indicated that they're excited about where we're going. So we're going to do everything that we can to, manage costs, increase revenues, and, raise in the current environment. Any more color on that, Finster? Sorry, I get a little fired up on some of these questions.
No, I think everybody can look at all the tickers, for us and others, and see that this has been a difficult environment in the last 2 months, and this is pretty dramatic change from when we had fundraised or when we've been raising capital previously. So I think you hit it on the head here.
Cool. And then we've got a couple of questions that are related to sort of future strategies, right? Why not take the company private? Have you entertained any buyout offers for the company? Would you consider selling Versus to a partner or a company like HP or Twitter? We are always on the lookout for what will produce the most value for shareholders. It is our job to do the best that we can. We serve at the pleasure of the board. I serve at the pleasure of the board. And it is my job to do everything that I can to produce value for shareholders, including myself, who also participated in the last round and who continues to support the company, the board that continues to support the company and continues to get excited about where we're going. So of course, we have looked at a wide variety of options, including taking the company for private. Yes, we have entertained buyout offers for the company. And yes, we would consider selling the company to anyone that could produce more value than we can. And we're going to continue to try to optimize the growth of the company, both on the cost side and on the revenue side. We're going to continue to grow against those 4 KPIs, contracts, increased contract revenue, advertising, and new verticals, including television and streaming. Those are areas that we're focused on every single day. And as soon as we are able to offer guidance, we're going to be offering guidance. But we like where we're standing now. We know that we're better today than we were in Q4, and better today than we were in Q3, and certainly better today than we were in Q1 of 2021. And we hope that if we continue to hit the milestones that we hit, that the market cap of the company will reflect that. And that's what we're trying to do, because we're doing everything that we can to return value to shareholders. And I appreciate everybody that included a whole mess of questions. If I didn't get to your question, hopefully, feel free to email. We're going to continue to try to knock those down, continue to be as transparent and as honest and as forthright as we can be about where we're going. For today, this is going to be where we wrap it up. But I appreciate everybody who's stayed on this long. But everybody that joined us today, thank you for supporting Versus. Thank you for being shareholders. Thank you for believing in what we do as we try to make the things that we touch more fun. And as we try to continue to produce value for our team, for our partners, and for our shareholders going forward. Thank you for your time. I very much appreciate it.